Oliver, we've worked together for a long time, and you know I have two great loves, capitalism and beer. Today, we're going to talk about both. The AB InBev SABMiller deal has been laid out in detail. What did we learn? Do we love the deal?
Well, what did we learn today? The terms were as they had been laid out a few weeks ago, so the terms themselves on you. We learned two things today. First, that in an effort to get this deal past the regulators, AB InBev has agreed to sell SABMiller's US joint venture to Molson Coors.
And we always knew that was going to happen.
We always knew that was going to happen. To get it past the US regulators, that's the very minimum they've got to do. Maybe they'll have to do more.
And do we know the price?
$12 billion.
Which is, again, about what was expected.
It was about what was expected. There was only really one realistic buyer for this half of the joint venture, and that was Molson Coors, of course, who owned the other half. So that was expected. The other number we had today was $1.4 billion, and that is the cost savings that AB InBev expects to get out of this.
And is that a big number, a small number, as expected, surprising?
It's not a huge number. Bear in mind that AB InBev is known for its cost-cutting abilities. They've made countless acquisitions before. The Brazilian team behind AB InBev, they bought Anheuser-Busch, they bought Modelo in Mexico more recently. They're known for very deep cost-cutting.
The famous quote, costs are like fingernails, they must be constantly clipped.
Indeed.
Powerful image.
It is indeed, as you sip your Budweiser.
Yeah.
But that 1.4 isn't very much. It's about 6% of SABMiller's sales. Now, in other deals, they've managed to squeeze double-digit percentages of cost savings. So it's not huge.
Are they talking down now so they can over-deliver later? That would be a typical corporate move.
It would be, and a typical AB InBev move. They've over-delivered on the Anheuser-Busch deal on the cost savings. They also over-delivered on the Modelo deal on the cost savings. So it looks as if they start low and then they sort of revise upwards. And I wouldn't be surprised to see that here again. But even when you revise upwards and look at the amount of savings, it still looks like they're paying a huge premium compared to the value of those savings.
So walk us through the math there a little bit.
So they've paid about a $35 billion premium for SABMiller's shares. Taxed and capitalized, the savings are worth nearer $10 billion. So there's a big gap.
So even if they over-deliver, right, even if they do double the savings, it's still not enough to cover the premium. So there's some extra value they have to recapture there over and above the cost savings they can get from the combination. Yeah. Where are they going to find that money, Oliver?
Well, that's a very good question. I'd say they could go further on the cost savings. They're very excited about the growth. They say there's wonderful potential.
But in theory, the growth was already in the stock price of SABMiller before they bid for it.
It was. Maybe they can get revenue synergies. Now, Lex, we're always very skeptical about the revenue synergies, but maybe they can do a better job of selling beer to emerging consumers in Africa than SABMiller could have done. After all, AB InBev has got some good, big global brands, Stella Artois, Budweiser, to name two of the biggest. So maybe they can really make a go of those brands in Africa and also in the other emerging markets in which SABMiller has big operations. But there's a lot of work to do to make it work financially. That said, they've been very good at acquisitions in the past, AB InBev, and I think perhaps they're worth the benefit of the doubt.
Thanks, Oliver.